Hello and welcome to our new series called Passive Pulse. We are thrilled to introduce you to the world of passive investing and tell you how these funds could potentially help you achieve your financial goals. Passive mutual funds are a smart, low cost way of investing in equity and debt markets. They've increasingly become popular in the recent past amongst young new investors. We're joined by A. Sundaresan, who will join us in the series to break down the investing strategies and potential benefits of investing in passive funds. Hi, Arun. Thank you very much for joining us today on the show. Arun, we very often hear words like ETF, passive investing. Some people argue that passive investing has become very popular recently. Start by telling our viewers what are ETFs and what are they suitable for? What is the role that they play in your portfolio? And how are they different from any other mutual fund?
Thank you for having me on the show. So a lot of times, all these words are used interchangeably, like passive funds, and they could be talking about a specific aspect of passive funds and so on and so forth. But passive funds in general are those funds which try to replicate an index, or in the case of commodity, like for example, if you want to invest in gold or silver, they invest into those commodities. They do more or less exactly as per the index. There is no active call. There is no fund manager who decides which stock to buy. Should I buy so much of this? Should I sell? So that's the main difference for passive. So largely they replicate the index. As a result, they tend to be low cost, which also has a lot of appeal for investors. But the cost angle notwithstanding, one of the other major advantages or one of the major um, uh, features that attract a lot of investors is the fact that you're not doing anything more than investing in the market. You're not taking any additional return or rather additional risk to generate extra returns. You want market exposure. Here is a product, here is a vehicle which allows you to do that. You're good enough. So that's the concept of ETFs and index funds, both combined together called passive funds. And that's possibly the reasons why they're very, very popular.
You're right, Arun. They are definitely low cost. And as indicated, it is an important tool in helping investors achieve their financial goals. Not to say that active investing is also not important, but let's talk about what you just mentioned. You said that an ETF or an index fund very simply replicates the index, like the word suggests in itself. And there is no role of an active fund manager in picking and choosing a specific stock for that matter. In that case, does an ETF have a fund manager? And if the answer to that is yes, then what is the role of the fund manager if all you're doing is replication?
Yeah, so they do have fund managers. Both ETF and index funds do have fund managers. And their role is to, while I did mention that passive funds largely try to replicate the index, doing that on an operational basis is rather challenging. So we will keep getting subscriptions on a continuous basis, both in ETFs as well as in index funds. And the fund manager will have to ensure that it gets deployed in exactly the same proportions. So that largely is a role of fund manager. Of course, there are a lot of other interfaces in terms of large investors investing and letting us know how many units to be purchased. So all of those finer things when it comes to operationally implementing them, those are very critical roles that fund managers play. But the main difference between a passive fund manager and active is that active fund managers have to think, they have to research, they will have to figure out what stocks to buy, when to sell, how much, and so on and so forth. That part is not there, but other things in terms of ensuring that you're replicating as closely to the index as possible and ensuring all other interfaces with investors, with their operations, with the fund flows and so on and so forth. Those are very, very critical aspects of investment management itself.
Right. Arun, we know that when you invest in an active fund, the fund manager does the job of ensuring the stocks that are picked out, for example, liquid. And if you want to make an exit from an active mutual fund, the process is rather simple and straightforward. What happens when you want to exit out of an ETF? Is that is that as liquid? Is it as simple and straightforward as exiting from an active mutual fund?
Uh,
And also elaborate on this because I believe a market maker is a person or an institution that ensures that the liquidity is provided when you need it, because that's what's most important attribute of a financial investment, right?
No, sure. So as I mentioned to you, exchange traded funds are listed on the stock exchanges. You transact in them just like how you do stocks or bonds. You go and buy and sell it on the stock exchange. So it's as simple, or if you think it's complicated, it's as straightforward as you do it in stocks, right? The only difference is that even in stocks, right, there are different types of stocks. There are stocks which are very, very large and therefore very liquid. There are also small cap and micro cap stocks where liquidity could be an issue. So whenever liquidity is an issue, you will have higher impact cost. You will not be able to transact at the prices that are displayed on the stock exchanges. The impact cost will be high, right? The same concept applies for ETFs as well. There are a few ETFs which are quite liquid. They enjoy natural liquidity, in which case you will be seamlessly you'll be able to invest into the market. You'll be able to transact, right? Buy and sell. There may be a few ETFs for various reasons. They may be slightly less liquid, which means that if you're going out to sell on the stock exchanges, there aren't enough buyers for those units. And that's when market makers come in. That's when they come into the picture. They provide the counter quotes. So if you're selling, they'll offer a quote to buy, and similarly for buy trades, they will come out with quotes for sell. So they will have quotes on either side on buy and sell, and by doing that, they ensure reasonable liquidity is there, and your transactions can go through at a reasonably good spread and not very high. So that's the role of market makers. But by and large, investing, transacting in ETFs is fairly simple. And given that the popularity is picking up, many ETFs are reasonably good in terms of liquidity.
Right. You didn't mention that it's quite simple to invest in an ETF. Is it as simple as buying a stock, Arun? I mean, do you do it through your demat account?
Absolutely. So it's the same as how you do it in your demat account. If you buy a stock yourself, it's exactly the same way. As I said, of course, the difference between buying a stock and this is that certain ETFs, depending on liquidity, if there is a challenge, there is a market maker who can provide that liquidity. That's not the case in stocks. If there is a stock which is let's say small cap in nature or micro cap in nature, where there is no liquidity, you will have no choice but to face a higher impact cost. On the other hand, there is an additional mechanism of market making where in the case of liquidity being relatively low, the market maker comes in to offer that liquidity. So I would say that by that comparison, ETFs actually score a little better when compared to transacting in an illiquid stock.
Aaron, recently at least, I mean, gold, of course, has been a very popular asset for Indians as whole. And very often when you talk about gold, you talk about gold ETF. So I do know that that is one asset class that one can use ETFs to invest in. I believe there's also equity. You want to walk me through which of the various asset classes ETFs invest in and what are their trading mechanics?
So, by and large, you can say three asset class. One is equity, two is debt, and the third is commodity, which today is gold and silver. So, in fact, the gold and silver formats are available only in ETF, which is a passive format, and fund of fund, which invest into ETF, which again can be termed as a passive strategy. So, these are not available on the active side. So necessarily, if you have to invest into gold and ETF, you are essentially talking about passive. So largely, these are the three asset class: equity, fixed income, and commodity. But having said that, within each of those asset classes, you have a whole variety of very, very interesting strategies. In fact, a lot of these strategies, many of them are very unique. They are quite innovative, and they can be very different from what you normally get through even the active format. So they offer a lot of variety to you. So depending on your specific requirement, your unique risk return appetite, you'll be able to find a whole lot of interesting options within both ETF as well as index funds.
Arun, at the start of this conversation, you mentioned of how index funds, ETFs replicate the index that they are tracking. Now, when you see returns of an index fund, is it a fair expectation as an investor that the returns of an index fund should exactly be the same returns that the benchmark itself gives, or is there a difference between the two? I'd imagine there shouldn't be a difference because they both are exactly the same, right?
There will be some difference, obviously. See, one, there is some, obviously, even though the cost element is low, there is an element of cost. To that extent, the return will be slightly lower. Then there are few statutory taxations, right? See, for example, every time you buy and sell stocks, securities, there is a STT, Securities Transaction Tax, which today is 10 basis point, right? So that also leads to some difference. Likewise, when we buy and sell securities, suppose there is Nifty index we are trying to replicate, there are 50 stocks, you're buying and selling them, there will be a brokerage involved. So when we also buy and sell, we'll have to pay brokerage to the stockbroker that we are dealing with. So that is a cost. All of these things will result in the scheme returns being slightly lower than your index. So index is in a way theoretical, right? So it's a sum total of all these stock prices. Now you're trying to replicate that. You have inbuilt cost to it, you have statutory taxes to take care of that, and then there can also be slight operational drags in the sense that there will be subscription, there will be redemption, there will be a little bit of cash component, and so on and so forth. So all of these things will result in the scheme returns being slightly different, rather slightly lower than the index. But the main point to keep in mind is that the returns will be very close. In the case of an active fund, the return when compared to the index can be very different. It can be very high, it
Right.
can be very different and low. So that's the risk and the return that you're seeking. That your return actually can be very different from the index. While you seek higher return, sometimes it can be lower as well. In the case of passive funds, you're seeking to get a return which is very close to the index, right? So
Mm.
that's how it works.
For somebody who doesn't do investing for a living, uh, it's also very tough to identify what stocks to buy, what sectors are going to work, what stocks in that specific sector could be a good bet. Keeping that in mind and the level of in-depth analysis that is required to pick up specific stocks, do you think it sometimes may just be better to buy a sector-specific ETF and ride that wave?
No, absolutely. And this is not just valid only for sector specific ETFs or index funds. Even the very concept of mutual fund is that, right? So instead of you trying to break your head as to which stocks to buy or which debt government securities to buy, sell, when, how to time it, the concept of mutual fund itself, and this applies both for active as well as passive, is that you're leaving that to one, either a fund manager to decide for yourself, or two, there is a portfolio or rather an index which consists of a set of stocks. You're not trying to figure out which is better, which is not, how much to buy. The index is already there. It gives you exposure to the market, and you just want to take that. So similarly, for example, you mentioned about sectoral ETFs and index fund. Suppose you have a positive view about, let's say, any sector, for example, banking, for whatever reason, because you believe that these things are happening, and that's positive for banking as a sector. But within that, you do not know which stock to buy, which banking stock to buy, how much, when, is it overvalued. So you're not an expert in that. So therefore, the easier option for you would be to select a banking ETF or a banking sectoral fund. The format can be anything. It can be the passive format like an ETF index, or you can choose an active banking fund. But essentially what you're doing is you're taking exposure to the banking sector, And in this case, within the banking sector, a slightly diversified exposure in the sense that multiple stocks rather than trying to identify one, two, or three stocks, right? So that's the entire concept. And the passive mode of investing, ETF and sector, your index-based investing, gives you an easy entry point to do that. So you already have a fund. You just close you made up your mind that banking looks good. You just go and invest into a banking ETF and banking index fund or any of the fund, and then at least you can be reasonably assured that I'm not getting into stock specific risk here.
You're right, and that's a big advantage because it's every company or stock in a given sector is still very different from the other, right? So sector rotation, stock rotation largely has been the theme of our markets. But thank you, Arun. Always good having you on the show. Thank you for talking to our viewers and telling them everything that they need to know about passive investing on this special edition of Passive Pulse.
Thank you. Pleasure being in the show.
An investor education and awareness initiative of Nippon India Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.